oil traded higher after the Saudis and the Russians said they will stick with their outputs through the end of this year. Of course, there are fears that a spreading conflict in the Middle East could disrupt crude shipments, but crude gave up the gains that it posted after Hamas attacked Israel on October 7th. Let's bring in David Szybunka, Senior Portfolio Manager and Co-Managing Director on the energy team at Canoe Financial. David, thanks very much for coming on the show.
Hey, thanks for having me.
When you wake up this morning and check out what's going on in the energy market, what's the first one or two things that you look at?
I mean, you kind of just brought it up on the geopolitical risk side where there is more things going on. And I think important for investors to think about is just all we've heard on the year has been a recession's coming. I mean, with that, we've watched record inflows into money market with where rates are, but we've also seen record outflows out of energy stocks. And so that dynamic has changed in the last 30 days because there's not as much focus on a recession coming and a lot more on a second war breaking out, geopolitical risk, massive M&A going on south of the border, alternative energy stocks hitting 52-week lows. Does this build out take longer? All of these things in a mixer are making investors feel like they are today, and it's a little less focused on a recession coming.
It is fascinating. Let's put up a 5-year chart for the TSX Energy Index. For a long time, energy stocks were in Siberia. A lot of investors didn't, not all, but let's say a substantial number of investors didn't want to be seen buying them. They were trading at very low multiples of cash flow. Is that still the case? Are they still very cheap by that measure?
That's an important dynamic. And so let's rewind the clock 2 years ago. When you go through a very hard, depressed period like Siberia, like you called it, everyone just wants their money back. What's my free cash flow yield? What's my dividend? What's my buyback? And so that's where we've been the last 2 years. We've been saying to our investors the last 5, 6, 7 months here, that's not where the puck's going. We want to be putting the chips in front of companies that screen really well on discounts to net asset value and some of the parts. And so shareholder returns are important, but these dynamics start to matter more. We've been saying this because there's a lot of cash in the system, but through this whole process, the last 6, 7 months, year to date, there's been a big difference of stock performance on the year. It's not only all boats lift anymore, the details start to matter. And with that, the valuations for certain companies have started to improve relative to others. This is really good. It tells us the sector's thawing. It tells us we're on the right track. It's not that these stocks are expensive. It's just the market is starting to award a certain cost of capital to certain guys, which is great.
You talk about MEG Energy, classic play on Canadian heavy oil. I think we're expecting their numbers fairly shortly. What's your attitude to a stock like that?
This is a core name for us because it ties into the theme I just laid out. Again, if you laid out the groundwork 2 years ago, people were buying MEG because it was a takeout target. Right. Then now they've been focused on what's my free cash flow yield? How many shares or dividend buybacks or those type of things am I going to get? Then as we look to MEG and its valuation starts to slowly expand, people start realizing it's a 50-plus year asset base, low sustaining capital. It has a lot of really good attributes relative to others. As we start maturing through things here, stocks like this get re-rated. And it becomes less important about the quarter to quarter. Did you hit these certain numbers? And more of what does this company look like 2, 3 years from now? We think we're going to go to a market where we're in the first stage of a CapEx cycle that investors will want MEG to use some of their free cash to invest more in their asset base. We're not there yet, but that's where we think we're going as we just continue to thaw through the sector.
Yeah, we are. We're expecting MEG to report after the market. That's interesting. You think that investors will change tack a bit here? They'll want to see more CapEx?
I don't think we're there yet. We're still in this part of the market where we're in some of the parts that discount to net asset value. Again, MEG stock has done really well on the year. It's up over 40% on the year as people are starting to figure this out. But as we keep maturing through the cycle, and by the way, commodity cycles take 10 to 15 years to play out, we're in year 3, investors will start to call on certain companies to spend more because they have the right attributes. And we are owning stocks like that in our portfolio, and MEG fits that degree really, really well.
Tell us, you're shifting your focus or your preference towards natural gas from oil. Tell us about your thinking there.
I mean, there's a bit of a match there. We have taken our natural gas exposure up, and I think it's important for people to realize, quit focusing solely on the commodities. Look what has happened here over the last few months. Again, I've described the backdrop where the geopolitical backdrop starts to elevate a little bit. M&A is going on. We watch natural gas prices go from $3.50 down to $2.90. The natural gas stocks were hitting new highs because they're more focused on, all of a sudden on the tape, you get rumors of Southwestern merging with Chesapeake. Those types of things. You think about oil prices, they ripped up to close to 90 on all of this geopolitical risk. They check back to 80. CNQ's hitting a 52-week high last week. So it's important to focus on the stocks, not solely the commodities.